Hello everyone. Today I'd like to share an interesting story with you, a personal experience that may offer valuable insights for anyone interested in investing and financial freedom. I'm currently working on a series about financial freedom, a subject I'm deeply passionate about. However, during the preparation, an unexpected incident occurred that I felt would be timely to share, especially for those contemplating entering the investment world. Speaking of personal investments, I've had the chance to be part of the financial market for quite some time. Over the years, I've accumulated some valuable lessons, especially in a volatile market like crypto. I've come to understand that investing isn't merely about putting money in for a profit. It's also a journey of self-awareness, understanding what we know and, perhaps more importantly, what we don't know. The lessons I'll be sharing today aren't directly about technical market analysis. They're broader in scope. These are perspectives on mindset and caution when investing, particularly in hot fields like cryptocurrency. I also want to emphasize that my intention isn't to give specific investment advice, nor am I here to encourage or discourage anyone from investing in crypto. If you've been following me on social media, you'll notice that I rarely, if ever, mention crypto. But this time, I'll make an exception and share some personal insights because this story might be useful for many people. Consider this a collection of stories and experiences I've been fortunate enough to gather through my career in the fields of finance and technology. I hope that by sharing them, you'll gain a new perspective and take time to consider carefully before making any investment decisions. When people talk about crypto, they often think of fast investment gains or the dramatic value increase of assets like Bitcoin or Ethereum. However, my journey with crypto didn't start with the intent to invest. It started with a fascination for the technology. Back when I first learned about crypto, it was still a relatively new concept, and conversations about it primarily took place among people in technology and finance, especially in the fintech sector. I was fortunate to work in both finance and technology in Australia, with my first position being at Commonwealth Bank, Australia's largest bank, known for investing heavily in technology. From there, I went on to collaborate with other major banks like ANZ and NAB, eventually working at a fintech company that was connected with Westpac. Through these experiences, I became acquainted with crypto, primarily through discussions with tech and fintech colleagues. When I first heard about Bitcoin and Ethereum, I was intrigued, but at the time, my interest was purely technological. I didn't buy or trade crypto. Back then, people in the crypto community primarily discussed the technology behind it, particularly blockchain, rather than focusing on profits or pricing. For me, crypto was a fascinating new technology to explore rather than an investment tool. To help illustrate the crypto community at that time, there was an ongoing debate about the primary function of Bitcoin. People tended to fall into two camps. One group saw Bitcoin as a form of currency for payments, while the other viewed it as a store of value, something akin to digital gold. Given the slow transaction speeds and volatile prices, the latter view ultimately became more widely accepted, with people seeing Bitcoin as a potential store of value rather than a practical, everyday payment method. It was around this time that I became deeply interested in Ethereum, particularly its concept of smart contracts. Unlike Bitcoin, Ethereum was designed as an ecosystem rather than a single tool. With smart contracts, Ethereum introduced practical applications that could address some of the limitations of Bitcoin. This idea inspired me and a group of colleagues to dive further into blockchain technology. One memorable event was a company hackathon, a competition where employees worked together to develop an innovative project within a 24 to 48 hour time frame. My colleague and I formed a team to work on a blockchain-related project, and we ended up winning second place with a prize of 3,000 Australian dollars. We decided to split the prize and purchase a small amount of crypto as a souvenir of the experience. My colleague bought 2 Bitcoins while I used my portion to buy 100 Ether. At that time, Ethereum was around 12 to 13 Australian dollars per coin, and our purchases were primarily for the sake of commemorating the hackathon rather than for investment purposes. After buying, we stored our crypto in a ledger, a cold storage wallet similar to keeping gold in a safe at home. We chose this method because we saw it more as a keepsake than an investment. For over a year, we almost forgot about it, leaving it untouched as a memento. None of us expected the value of crypto to surge as it eventually did, because at that point, the market was still relatively obscure and very volatile. Then, in 2017, the crypto market began to explode, with prices skyrocketing. The media, social circles, and public discussion all became fixated on Bitcoin, Ethereum, and other digital assets. From a humble 12 Australian dollars, Ethereum had soared to around 400 Australian dollars per coin, giving me nearly a 4,000% return. Despite my years of research in blockchain technology, I was still astonished by the rapid price rise. In this climate, I decided to sell half of my Ethereum when it hit 400 Australian dollars, a price that represented a remarkable profit. That sale alone funded a new MacBook Pro and allowed me to reinvest in the stock market, a field where I had more experience and confidence compared to crypto. When I sold, some thought I was crazy for selling at 400 Australian dollars, but for me, a 4,000% return was more than sufficient. At that time, I wasn't trying to predict whether the price would continue to rise or fall. And as the market later showed, crypto values can fluctuate wildly, both up and down. The remaining amount of Ethereum I held, I intended to keep as a memento of my time researching blockchain technology. But the story doesn't end there. 3 years later, in 2020, the crypto market surged once again with growth rates that were even more intense. Right around this time, I had a conversation with a younger colleague who had recently ventured into crypto. While talking with him, I realized that he reminded me a lot of my friend from 2017, enthusiastic but lacking in depth, relying mainly on general news and surface level information from the community. I saw that once again, this colleague was a taxi driver in my story. That night, I decided to sell the remaining 10 Ethereum I still held. Coincidentally, the market crashed the very next day. Though this could have been just a matter of timing, I felt reassured in my decision. Each time, my choice to sell stemmed from a fundamental belief. When markets become too popular and accessible, and when even non-experts begin investing, it's often a signal to step back. This experience taught me a critical lesson. The financial market is not always an easy place to make money. Investment decisions can be wise, but they can also be mere gambling if one doesn't understand the full picture. Through this journey, I learned that the most important thing is to recognize the limits of one's knowledge, and that when a market overheats, stepping out can sometimes be the wisest move. In early 2017, the crypto market exploded, with Bitcoin and Ethereum skyrocketing in value. At that time, I still viewed my crypto holdings as a hackathon memento. But as crypto news and market hype spread everywhere, I began to seriously consider cashing out. Why would I sell when prices were soaring? One piece of advice from a mentor has always stuck with me. When your taxi driver starts giving you investment tips, it's time to sell. This advice isn't intended to look down on people without investment backgrounds. Rather, it's a cautionary warning. When everyone around you, even those without experience, starts jumping into the market, it may be a signal that the market is becoming overheated. During that time, not only was crypto everywhere in the media, but my friends and colleagues, people who'd never discussed investing before, were also suddenly enthusiastic about it. One day in November 2017, I vividly remember having lunch with a group of friends, one of whom was eagerly talking about Bitcoin's future. He was convinced it would change the world and become a global payment tool. At first, I just listened, but then I asked him a few questions about the technical side of crypto, like financial regulations and the technology's limitations. He couldn't provide solid answers. That's when it hit me. He was the taxi driver in my mentor's story, enthusiastically jumping into crypto without a full understanding. That night, I went home and decided to sell nearly all of my Ethereum, keeping only 10 coins as a memento. A few weeks later, the market continued to surge, reaching a peak in January 2018 when Ethereum hit 1,700 Australian dollars per coin. People asked if I regretted selling at 400 Australian dollars, and to be honest, I felt a bit of seller's remorse, but when I looked at the big picture, I knew I'd made the right call, especially as crypto prices began to plummet soon after. By selling at that time, I'd locked in substantial profits and avoided the massive crash that followed. With the profits, I invested in the stock market, an area where I felt more secure given my background and knowledge. This decision aligned with a personal rule I've always followed. If I'm going to invest, it should be in something I truly understand. I told myself that if I ever wanted to gamble, I'd go to a casino. When it comes to investing, I want my choices to be informed and deliberate. The small amount of Ethereum I held onto wasn't intended for profit, but as a reminder of my time exploring blockchain technology and the early days of crypto. But the story didn't end there. 3 years later, in 2020, crypto prices once again skyrocketed, this time with even more intensity. Around this period, I had a conversation with a younger colleague who had just ventured into crypto investing. Talking with him, I quickly saw he was a lot like my friend from 2017, enthusiastic but lacking in-depth knowledge, relying mostly on secondhand information. I realized he was once again the taxi driver in my story. That same night, I decided to sell the last 10 Ethereum I still held. Coincidentally, the market crashed the very next day. While that timing may have been sheer luck, it reinforced my decision. Each time I chose to sell, it wasn't based on predictions or market timing. It was simply because I followed the advice to step back when the market becomes too popular and flooded with novice investors. This experience taught me a fundamental lesson. Financial markets aren't always as simple as they appear. Investment decisions can feel wise at times, but without a clear understanding, they may be more akin to gambling. Through this journey, I've learned that the most valuable asset in investing is understanding the limits of your own knowledge. And when the market overheats, stepping away can be the safest choice. From my investment journey, I've learned two valuable lessons. These principles apply not only to crypto, but to any investment decision, and even beyond that, to life itself. Lesson 1, know what you don't know. When entering a new field, the first thing I realized is that no one can grasp every detail immediately. When I began studying blockchain, I delved deeply into its technology, understanding how it functioned from a technical perspective. However, I soon recognized that understanding the technology alone wasn't enough for a smart investment. I lacked knowledge about the global monetary system, governmental regulations, and the complex dynamics of financial markets. Although I was familiar with blockchain technology, I knew this didn't mean I had a complete foundation to make confident investment choices in crypto. We often hear the saying, know enough to know that you don't know. This principle is critical when it comes to investing because many people fall into the trap of overconfidence after learning the basics. They might think they're ready to make investment decisions, but without comprehensive knowledge, they risk making uninformed choices. For me, if I don't understand how financial systems work or don't have a solid grasp of regulatory frameworks, I can't confidently say that I'm equipped to invest responsibly. I once saw this firsthand with a younger colleague who decided to invest in crude oil, a sector even more complex than crypto. Watching his moves, it was evident that his early successes were largely due to luck. However, these initial wins made him feel like an expert in oil, even though his understanding was surface level. This situation reminded me of an eye-opening experience I had years ago when attending a global economic forum with my finance colleagues. There, global leaders and financial experts gathered to discuss and shape economic policies. I quickly realized that my knowledge of commodities like oil or gold was minimal. I also recognized that 90% of people trading these resources were essentially gambling rather than making informed investments. Since then, I've decided to only invest in what I genuinely understand and can control. This is the first lesson I want to share. Take the time to identify what you know and, more importantly, what you don't know. This humility doesn't just prevent poor investment choices, it fosters a mindset of continual learning, helping you bridge the gaps in your understanding. Lesson 2. Be wary when the market becomes popular. The second lesson I learned is to always be cautious when a market becomes extremely popular and accessible to the general public. Why? Because when too many people join in without deep knowledge, it's often a sign of a potential bubble forming. During my years in finance, a mentor once told me a piece of advice that has stayed with me. When your taxi driver starts giving you investment tips, it's time to sell. The idea isn't to look down on those without experience, but to recognize a signal of market overheating. When you notice friends, family, and colleagues, people who previously had no interest in investing, suddenly jumping into crypto or another hot trend, it's a good time to be cautious. I experienced this personally in 2017 when the crypto market surged. At that time, media outlets were buzzing with news about Bitcoin, Ethereum, and other digital assets. Friends around me, even those who had never shown interest in investments before, began discussing crypto and giving advice. During a lunch meeting just before the Christmas break, a friend who lacked technical knowledge about blockchain was enthusiastically talking about Bitcoin's future, explaining how it would revolutionize global transactions. As I listened, I recalled my mentor's advice and sensed the signs of an overheated market. After that conversation, I decided to sell nearly all of my Ethereum, keeping only a few coins as a memento. Although Ethereum continued to rise afterward, I felt confident in my choice to step back. Only a few months later, the crypto market crashed. For me, preserving my gains felt more important than the potential risk of chasing the peak. The essential takeaway here is this: stick to your principles and don't get swept away by market trends. When you see experts giving advice, or when everyone seems to be investing without fully understanding, it's often a sign that you should consider stepping back. Conclusion: these two lessons have given me a more grounded perspective on investing, not only in crypto, but across many financial areas. The first lesson is to always know what you know and what you don't know. This recognition can protect you from risky investment choices. The second lesson is to be cautious when markets become overly popular. Observe the market and don't hesitate to step back if it doesn't align with your investment approach. Investing isn't only about earning profits, it's about maintaining principles and knowing when it's time to walk away. I hope these lessons provide you with a valuable perspective and deeper insight as you embark on your own investment journey. Through the experiences and lessons I've shared, I hope you've gained a more realistic and grounded approach to investing, especially in high-risk markets like crypto. Investing isn't just about seeking profits. It's a journey of self-awareness, staying grounded in your principles and recognizing the limits of your own knowledge. No matter how enticing or fast-moving a market may seem, it's crucial to understand both what you know and what you don't, and to avoid being swept away by the latest trends. Looking ahead, I'm preparing a series of detailed posts on financial freedom, a subject I'm deeply passionate about. This journey goes beyond investment decisions and involves personal finance management, long-term planning, and achieving a state of freedom that allows you to live a fulfilling and worry-free life. I believe financial freedom brings not only material benefits, but also the opportunity to enjoy a meaningful, balanced life. Thank you for listening to my story and for spending time with me today. If you found these insights valuable, please share them with your friends and family. And if you're interested in following my upcoming series on financial freedom, hit subscribe to receive notifications on new content. I look forward to sharing more insights and experiences with you that can help make our financial journeys more secure and fulfilling.